Hello, I'm Bob Hartwig, and I'm a professor of finance, risk management, and insurance at the University of South Carolina. It's my pleasure to be here with you and to help you understand a bit more about what the impacts have been with respect to recent events in the property liability insurance industry, and particularly what those impacts are going to be in terms of 2018 renewal business. There are a lot of factors here, but I think everybody knows that 2017 was a year for the record books. After a relatively quiet period, 2017 on a global scale shattered records or came very close to records in terms of catastrophe losses. Not just terms of hurricanes, but wildfires and also flooding events all around the planet. But in addition, we have other pressures, some of which you may not have paid that much attention to in the sense that they were really in the background. And one of these would be low interest rates. Low interest rates are not something new. They've been around ever since the financial crisis. And the reality is that the insurance industry is still trying to adjust to this low interest rate environment that we have today. And even though rates have come up a bit, they're still far, far below their pre-crisis levels, generating additional rate pressure. And in addition, we also have some claim frequency and severity issues in key lines, such as commercial auto, and of course in some areas, such as property, where we've seen the headline catastrophes, not just hurricanes, but such things as wildfires as well. So what to expect in terms of 2018 renewals will, as always, depend on your individual exposures and your individual experience. And loss-affected accounts in particular are likely to see the largest increases, perhaps somewhere in the 5 to as much as 15% range. Non-loss affected accounts somewhat less, again, depending on location and a variety of other factors. But certain other coverages, such as commercial auto, D&O, and cyber, for some very obvious reasons, such as an outbreak in securities lawsuits, an outbreak in terms of rapid increase in the frequency of vehicle claims on the highways and byways of America, and of course, the very high-profile cyber breaches we've seen all across the world in 2017 are creating pressures in other lines as well. So let me take a little bit of a deeper dive into this. What is driving the prediction for a bit of a firming in the commercial insurance markets in 2018? Well, again, we already mentioned the record or near record catastrophe losses. This was all over the headlines for the entirety of the past year, and quite frankly, these events are likely to continue into 2018. There's no reason to believe that they will not. 2017 was one of the 3 costliest years in global history for insurers. We've had very large underwriting losses generated by these record catastrophes, combined with years of underpriced business in other key lines, such as commercial auto, and rising reinsurance prices. This is one pressure that all insurers are seeing today around the world. Reinsurers were hit hard, as were retrocessional arrangements, that is, reinsurance for reinsurers, whereby the risks of the catastrophes of the past year were spread around the world. The low interest rate environment, again, although the Federal Reserve has edged rates up ever so slowly, the reality of it is that a full normalization of interest rates in the United States is not likely until the early or mid-2020s. Now, this has brought the ROEs of the insurance industry under tremendous pressure. Sharply higher underwriting losses, chronic underpricing in key lines, depressed investment earnings have all conspired to drag the ROEs of the industry down to 15-year lows. And of course, you can't get away from the fact that geopolitical risk is rising everywhere. Again, it is a headline issue, but it means the world is risky. We in the insurance industry, in the reinsurance world, know it's risky, and that too can generate uncertainty that can pressure rates further upward in certain key lines. Here is a time trend over the past 17 years of insured catastrophe losses on a global scale. And you can see that 2017 is estimated right now at about $135 billion in insured losses. These numbers are inflation adjusted, and what you can see is it's right up there with 2011, where we had record catastrophe losses, and 2005, the year of Hurricane Katrina, Rita, and Wilma. Put these events in history, what we can see is an incredible piece of history being made in 2017. 3 of the top 18 events ever in the United States occurred last year in 2017. And in fact, 15 of the 18 most expensive events in insurance history occurred since 2004. So how do we get to the point whereby we can predict that there's pressure in terms of the 2018 renewals? It's useful to think how the losses from last year and in recent years have been distributed. Ultimately, of course, the losses initially begin with the insurers themselves. Those insurers, of course, are reinsured, and those reinsurers in turn have spread those risks and syndicated those risks around the world through the retrocessional market. And that's where the real pressure is right now. We're seeing rates for 2018 are up 30 to 50%. That's truly extraordinary. That is creating pressure in the property catastrophe reinsurance markets, plus 5 to 15%. That trickles down into the primary insurance, commercial lines, and personal lines markets on the property side of somewhere between 3 to 10%, but even more on the most affected account. So what you see here is years of decline in reinsurance pricing. Reinsurers were hit very, very hard. Pricing went down because catastrophe loss activity was subdued for a number of years prior to 2017, generally speaking. But so obviously, as those losses have gone up, reinsurers are paying a very large share of the losses from 2017. And of course, that has pricing impacts, both on their balance sheets as well as in their income statements. We're going to look at both of those here. We're going to begin with the balance sheet. We're going to see how the catastrophes, as well as the non-catastrophe related underwriting losses, are impacting the industry today. Now, make sure that you understand, of course, that the industry remains strong. It remains solvent. It remains secure. And it's in everyone's best interest to make sure that it remains that way. And that is part of the imperative, of course, of making sure that rates are adequate across the industry. What we could see is a projection for a decline in the industry's surplus. In other words, its capacity by year-end 2017. Now, expecting a drop of somewhere of $20 to $30 billion relative to the peak earlier in mid of 2017, before the hurricane season began. And herein you can sort of see that risk. What you can see is literally the results that insurers are seeing. That last year, in 2017, the industry had a combined ratio of about 110. What does that mean? It means that the industry paid out about $1.10 for every dollar in premium that it took in. This is having consequences also in terms of profitability for the industry. What we see is a very, very sharp decline in the industry's ROE in 2017 to approximately 0%. That is the lowest number since 2001, the year of 9/11. We've never suffered catastrophic losses of this magnitude in an environment where the investment income was as flat as it is. That is truly unique. Even in 2001, interest rates were much higher than they were today. In 2005, much higher than they are today. So the industry does not have that investment income offset to the extent that it did in prior years. Again, large underwriting losses, depressed investment earnings, and sluggish premium growth. That's the new element we're going to bring in right now. We're going to take a look at what is happening to premium growth, which predates the catastrophes that we've seen over the last year. And in fact, the impacts here are so extraordinary, it's quite possible that cash flow on net was actually negative in 2017. So what we see is the near disappearance of net income. In other words, profit, after-tax profit in the industry in 2017. That is driving the ROE down to effectively zero or something very, very close to that. And the last time this happened was in 2008, which was in the midst of the financial crisis and also as a result of Hurricane Ike that year. And you have to go back to 2001 and 2002, the 9/11 environment and the immediate post-9/11 environment, to see a comparable year. We see that investment income, which is principally generated off the industry's bond portfolio, and the industry is very, very heavily invested in bonds. This industry needs to stay strong, stable, sound, secure, and highly liquid. So about 2/3 of the industry's investments, in fact, are in bonds. And that means that the industry is subject to all the problems that have affected pension funds and everybody else because of low interest rates. There's really no alternative for the industry. So we're along for this ride as long as this ride lasts. And what we see is that investment income today remains depressed. It is still 14 to 15% below what it was prior to the financial crisis. And we could see, if we sort of take a longer term view of this, that in fact the yield on the insurance industry's investment portfolio is at its lowest level in half a century. Again, this is adding to the pressure associated with the large-scale underwriting losses being generated from record catastrophes as well as underpriced business. This chart shows about 40 years, more than 40 years of the annual change of net written premiums in commercial lines only. And today, commercial lines amount to about $250 billion in the United States, which is about identical to what personal lines is nowadays. And what you can see is that premium growth in recent years, since about 2011 or so, has actually been decelerating. So why would it decelerate? Well, in large part because the rate environment has been weakening a bit in commercial lines, and also because of relatively moribund economic activity. What we generate in commercial lines is very tied to overall economic activity. But over time, the pricing has slid, and this has led to a deterioration in a number of key lines. So with the enormous losses that we saw recently, this is likely to put upward pressure ultimately on premiums in commercial lines. We're roughly probably at about 2% as we ended 2017. So as we move into 2018 and beyond, we would expect an acceleration here. And to illustrate this point of the mild cyclicality that we're seeing right now, you could see how renewals back to late 2014 or so were generally renewing in a negative direction. Not by double digits, by low single digits typically. Some accounts might have been flat and some accounts might have renewed a bit more negatively. But if you go to the period immediately prior to that, 2011, 12, 13, you saw renewals in positive territory. Something very modest, 3, 4, 5% range. Again, certain accounts, depending on their exposures, depending on their experience, would have seen a bit more or less. So what we're projecting is for 2018 is to begin to see a simple and a relatively gentle return to the renewal structure that we saw perhaps in the 2012-13 era. The most recent data in the middle of 2017, prior to the major catastrophic events, showed only one major commercial line showing substantial increases, and that was commercial auto. You saw the other major commercial lines, especially commercial property, business interruption, GL, renewing in a downward direction. And obviously the major cats are going to put tremendous pressure on commercial property, business interruption, the continued pressure, it'll remain on commercial auto. We'd expect the increase in lawsuits, certainly in securities lawsuits, to be pushing up D&O. Expect to see some change in a couple of other of these lines as well as we move through 2018. Now there is good news. And in fact, as I mentioned, the industry does remain strong, stable, sound, and secure. And the interest, of course, is to have it remain that way. But to give you an example of a line that not too long ago was in trouble, let's take a look at workers' compensation. As recently as 2010, 2011, the combined ratio in workers' comp was 115, paying out $1.15 for every dollar earned in premium. That was a money-losing operation. But you could see how those results improved dramatically within the span of a few years. That was done almost entirely by ensuring that there was a return, and a relatively rapid return, to rate adequacy. And so now we're seeing combined ratios in workers' comp running around 94 or 95. The market is very healthy, very competitive, and growing, both as a result of strong exposure growth in terms of number of jobs created, some wage growth as well, and relatively reasonable trends in terms of underlying loss costs, which are supporting relatively modest rate trends. We also see some pressure in the area of D&O, and one good way to see that is to see the recent but sustained increase in the number of federal securities class actions. And I could look at a variety of type of class actions, but it's good to look at the securities class actions here. You could see how this has rocketed up rapidly with a more than doubling since 2013, with no signs of this relenting at all. So clearly this is pressuring D&O rates across the country in 2018 and beyond. Let me just summarize for a moment what to expect for your 2018 renewals, and most importantly, why. We talked a lot about why pressure on rate is mounting. It's coming from a variety of quarters. We all know that 2017 was a record or a near record year for catastrophes, not just in the U.S. but on a global scale. And that rates, of course, will need to adjust to reflect pressure on both the primary commercial and reinsurance markets. Persistently low interest rates, a very important but unappreciated factor in terms of pressuring commercial lines rates, again, particularly the long tail lines, such as workers' compensation. And the rising claim frequency and severities in lines such as commercial auto, as the highways and byways of America become more and more crowded. What we also see is that this pricing reaction, if we look in history, many times we can see that it's a normal part of the property casualty insurance underwriting cycle. There's nothing new about it. It just hasn't happened in a while. And in fact, it's not in the experience of many people who've been in the industry, who are in the industry today. 2018 renewals, again, to summarize, could be in the mid to upper single digits and somewhat more for loss-affected accounts. But the good news is that the industry remains strong, stable, sound, secure, with many opportunities ahead. But to realize these opportunities, this will require a commitment of significant additional insurer capital. And the industry needs to remain strong throughout this period, and I have every belief that it will. Thank you very much for your time and your attention. It's been my pleasure to speak to you today.